Blackstone eyeing the global cricket league is exactly why I love private equity. Talk about an untapped market.
You just like sports gossip. Apollo dropping 3.7 billion on Nippon Sheet Glass is the actual story.
Oh, come on. Glass? It is literally transparent. That is just a boring industrial roll-up.
Solar glass, Nate. Read the footnotes. But fine, if you want real drama, SK Hynix is spending nearly 8 billion just to kneecap Samsung.
Now that is a bloodbath we need to unpack. The rundown. So if you're keeping track at home, that's $1.68 billion Gilead is throwing at Ouro Medicines.
Clinical stage autoimmune T-cell therapies, which is a mouthful, but Gilead needed this. Their pipeline was looking a little thin in immunology.
It's classic big pharma panic buying. They see a patent cliff, they just open the checkbook.
I wouldn't call it panic buying. The data on Ouro actually looks solid if you read the Phase 2 summaries.
Fair enough. But speaking of weird checkbooks, look at 3M and Bain Capital teaming up to buy Madison Fire and Rescue. $1.95 billion.
This is the one that gave me a headache this morning. Since when does 3M need Bain to hold its hand on a $2 billion deal?
Oh, come on, it's a brilliant structure. 3M gets the strategic asset, Bain takes on the operational heavy lifting. I used to pitch this exact co-sponsor model all the time.
Yeah, and how many of those pitches actually close, Nate?
Okay, that's a low blow. But seriously, fire and rescue equipment is a steady cash flow business. Bain loves steady cash flow.
I just hate the governance on these corporate private equity club deals. The press release was all synergy buzzwords, but the footnotes scream future board dispute. Who actually calls the shots when growth slows down?
The guy with the biggest spreadsheet, which usually means Bain. But look, corporate elbows are flying everywhere right now. Did you see SK Hynix dropping $7.9 billion on ASML equipment?
I did.
That's a direct, aggressive shot across the bow at Samsung. They're playing for keeps in the AI memory wars.
It's a massive hardware bet, which makes sense because the big one.
You don't spend $3.7 billion on a glass company unless you see something the public markets are completely missing.
Or unless you just really, really like Windows, Nate.
Very funny, but seriously, Apollo buying Nippon Sheet Glass. This is the ultimate private equity flex. It's boring, it's heavy manufacturing, and it has a massive global footprint.
I'm looking at the operating metrics for NSG right now. Architectural glass, automotive, solar. Solar is the shiny object here, obviously. But let's be real, auto and commercial construction, those are highly cyclical, capital-intensive nightmare sectors right now.
Which is exactly why Apollo wants it. They love a messy, cyclical asset. The public markets absolutely hate earnings volatility. Apollo just sees a depressed multiple, a temporary trough in commercial real estate, and says, thank you very much, we will take that off your hands.
I don't buy the depressed multiple narrative completely. 3.7 billion isn't exactly a bargain basement price for a business with these CapEx requirements. You're paying a premium for the solar division, and just praying the auto glass side doesn't bleed your margins out over the next 3 years.
But Maya, zoom out. Think about the macro picture. Every new green building needs smart glass. Every electric vehicle needs specialized lightweight windshields. You're not just buying a legacy glassmaker. You're buying a toll road for the energy transition.
A toll road? Wow, you're really dusting off the old banker pitch deck metaphors today.
Hey, the classics play for a reason. I'm just saying. This is infrastructure investing masquerading as a traditional buyout. It's smart.
Okay, fine. I'll grant you the solar glass angle. But I read the press release, and of course, they buried the actual growth projections for the legacy architectural division way down in footnote 7.
You and footnote 7, a legendary romance.
Somebody has to read them. And footnote 7 basically admits they're banking entirely on government green building subsidies to maintain their architectural margins. If those policies shift, the math on this 3.7 billion gets very tight, very fast.
Tight, maybe, but Apollo knows how to squeeze margin out of a stone or, sand, because it's glass.
Please never make that joke again.
I make no promises, but honestly, I get why PE is pivoting back to heavy industry. Look at that Equitech report that just dropped. Buyers are getting incredibly paranoid about AI-driven assets right now. The due diligence on tech deals is taking months longer than it used to.
Because nobody knows what's actually proprietary tech and what's just an OpenAI wrapper. With Glass, you can walk into a factory and literally kick the furnace.
Exactly. Though speaking of tech, SK Hynix isn't showing any caution. They're out here dropping $7.9 billion on ASML equipment.
Now that is a corporate street fight. They're aiming right at Samsung's throat in the AI memory space.
Yep. Elbows are flying. But if you want a real wild pitch, we need to talk about Blackstone. Have you heard these whispers about them buying into the global cricket league?
I have. And I have so many questions about how a New York buyout shop builds a valuation model for a cricket franchise. Voices.
I read the new Equitech Global Buyers report this morning, and I'm feeling incredibly vindicated.
Oh no. What did they validate for you this time?
They're officially calling out a massive vibe shift in AI deals. Buyers are apparently exhibiting growing caution and throwing down way stricter due diligence on AI-driven assets.
Well, it's about time. You can't just slap a .ai on your pitch deck and expect a 10x multiple anymore. People are finally reading the footnotes.
See, I read it differently. I don't think it's about reading footnotes. I think buyers are just paralyzed because nobody actually knows how to value these things. The tech boom is still happening, but the bankers are terrified of catching a falling knife.
Terrified? No. They're just realizing 90% of these startups are just OpenAI wrappers with a marketing budget. Stricter DD just means asking, hey, do you actually own any proprietary tech or are you just renting an API?
You're so cynical.
I'm accurate. Look at the data. Equitech is just saying out loud what every associate in a data room has been crying about for 6 months. The revenue models for these AI assets are completely untested.
I still think it's a pricing standoff. Sellers want 2023 hype prices. Buyers want 2024 reality prices. But fine, I'll give you the API point. Speaking of adjustments, did you see the Philippine Competition Commission update?
The threshold bump.
Yes, they just raised their merger notification threshold to 9.1 billion Philippine pesos, which sounds like a terrifyingly massive number until you do the math.
It's roughly 160 million US dollars.
Exactly. The regulators are saying it's a necessary adjustment for inflation to prioritize deals with genuine competitive impact.
Translation? Please stop sending us paperwork for tiny middle market deals. Our desks are collapsing.
It makes sense, though. Inflation is pushing every standard tuck-in acquisition over the old limits.
Which just clogs up the system. It's actually a very smart regulatory move. Focus on the actual monopolies, ignore the noise.
I love when you praise regulators. It happens so rarely.
Don't get used to it.
I won't. But speaking of things crossing the finish line and getting regulatory sign-off, we've got some serious closings to watch tomorrow.
Especially in energy and regional banking. Spill the tea.
$7.9 billion on ASML equipment. SK Hynix isn't just throwing elbows at Samsung here, they're bringing a steel chair to the AI memory wars.
I'm looking at the actual CapEx numbers and I'm not sure it's a steel chair. It looks more like a very expensive insurance policy.
Oh, come on. You don't spend almost $8 billion on extreme ultraviolet lithography machines just to play defense. That is a direct, aggressive maneuver to completely undercut Samsung.
But look at the context. Equitech just released their global buyers report, and they're seeing massive caution and way stricter due diligence on AI-driven assets right now. The software valuations are completely detached from reality. So if you're SK Hynix, you don't buy the hyped-up AI startups. You buy the picks and shovels. You buy the machines that make the chips. It's practical, not dramatic.
I know you hate the narrative, but practicality doesn't make for a good headline, Maya. Let me have my corporate drama. Speaking of wild narratives, did you hear the whispers coming out of Blackstone?
The cricket thing?
The cricket thing. They are actively evaluating taking a major stake in the global cricket league.
Wait, really? I saw the rumor crossing my desk, but I thought it was just somebody making a terrible joke about private equity trying to hit a boundary.
No, it's real. Think about the sheer scale of the global fan base. It's actually a classic private equity play if you strip away the sports aspect. You find an asset with massive, sticky, recurring revenue potential, broadcast rights, and you optimize the monetization structure.
I guess I need to learn how a wicket works before their next investor day. But before we start pricing out cricket bats, we should flag a couple of deals actually crossing the finish line tomorrow.
Right, keep an eye on Pelican Acquisition. Their merger with Greenland Exploration is expected to close, spinning up a brand new publicly traded energy player.
And the Ballston Spa Bancorp and NBC Bancorp merger is also slated to close. They just got fresh shareholder approvals, so we'll be watching the final paperwork on that one tomorrow morning. Tomorrow's radar.
Tomorrow morning, we finally get the Pelican and Greenland Exploration close, a brand new publicly traded energy player.
I'm setting an over-under of 4 days before short sellers pick apart their reserves data.
Oh, come on, they have solid acreage.
We'll see. What I'm actually watching tomorrow is the new Equitech report. Buyers are finally demanding real due diligence on AI assets. The hype premium is shrinking.
I strongly disagree. SK Hynix just dropped $7.9 billion on ASML equipment to elbow out Samsung. That's pure AI arms race behavior. Nobody is slowing down.
Buying hard lithography machines is entirely different than buying a startup with a pitch deck that just says .ai on the cover.
Fair point. Speaking of pitch decks, the rumor mill says Blackstone is looking at a massive stake in the global cricket league.
Wait, really? Private equity buying into cricket?
Billions of fans, Maya. Uncapped media rights. It's a banker's dream.
I can't wait to read the EBITDA adjustments on a cricket franchise. We'll catch you next time.